This question tests the concept of inventory valuation under variable costing. Under the variable costing, direct costing method, only variable manufacturing costs are treated as inventoriable product costs. All fixed manufacturing overhead and selling and marketing costs are treated as period costs and are expensed in the period incurred. The key phrase is, uses the variable cost method to value inventory. Students should remember the following classification. Are included in inventory, product costs. O direct materials. O direct labor. O variable manufacturing overhead. O, collectively referred to here as variable manufacturing costs. Are excluded from inventory, period costs. O fixed manufacturing costs. O variable marketing costs. O fixed marketing costs. The problem states that none of the products have been shipped, meaning all production remains in ending inventory. Therefore, the inventory value equals only the variable manufacturing costs incurred. The costs incurred are variable manufacturing costs, $5 million. A fixed manufacturing costs, $2 million. Variable marketing costs, $1 million. A fixed marketing costs, $3 million. Under variable costing, only the $5 million variable manufacturing costs are included in inventory. A. $5 million. Correct. This represents the total inventoriable cost under variable costing. B. $6 million. Incorrect. This improperly includes part of the marketing or fixed manufacturing costs. C. $8 million. Incorrect. This includes non-inventoriable costs. D. $11 million. Incorrect. This includes all manufacturing and marketing costs, which is inconsistent with variable costing. Correct answer. A. $5 million. Under the variable costing method, only variable manufacturing costs are assigned to inventory, while fixed manufacturing costs and all marketing costs are expensed immediately. Since no units have been sold, the ending inventory is $5 million. This question tests the conceptual justification for variable costing compared to absorption costing. Students must understand why management accounting prefers variable costing for internal decision-making. Under variable costing, only variable manufacturing costs are treated as product costs, while fixed manufacturing overhead is treated as a period cost. This aligns better with decision-making because fixed manufacturing costs are generally capacity-related rather than product-related. Key idea. Fixed factory overhead does not change with each unit produced. It is incurred to maintain production capacity, not to manufacture a specific unit. Therefore, it should not be assigned to individual products for internal decision-making. Variable costing is especially useful for CVP analysis, contribution margin analysis, short-term decision-making. Fixed factory overhead is more closely related to the capacity to produce than to the production of specific units. Correct. This is the best conceptual justification for variable costing. Fixed manufacturing overhead supports the production facility as a whole, not individual units. Therefore, it should be treated as a period cost, not a product cost. B. All costs are variable in the long term. Incorrect. While some costs may become variable over a long horizon, this is not a valid justification for variable costing in managerial accounting. C. Variable costing is acceptable for income tax reporting purposes. Incorrect. Tax authorities generally require absorption costing, not variable costing. D. Variable costing usually results in higher operating income than if a company uses absorption costing. Incorrect. This is not always true. Income depends on production versus sales levels. Correct answer. Variable costing is preferred because fixed manufacturing overhead is related to production capacity, not individual units, making it more useful for decision-making and internal performance evaluation. This question tests the concept of joint cost allocation and common costs, specifically the purpose of allocating joint, common, costs to joint products. Key ideas. Joint products are two or more products produced simultaneously from a common process and cannot be separately identified until the split-off point. Common, joint, costs are incurred before the split-off point and are not directly traceable to individual products. Therefore, these costs are allocated arbitrarily using methods such as physical units method, sales value at split-off net realizable value method. Important conceptual point. Joint cost allocation is not useful for decision-making because the costs are sunk and irrelevant for future decisions. Its main purpose is financial reporting, particularly inventory valuation and income determination. Thus, students should focus on why accounting standards require allocation, not managerial decision usefulness. A. The selling price of a byproduct. Incorrect. Selling price is determined by the market, not by cost allocation. B. Whether or not one of the joint products should be discontinued. Incorrect. Joint costs are irrelevant for discontinuation decisions because they are sunk costs. C. The variance between budgeted and actual common costs. Incorrect. Variance analysis applies to controllable costs, not allocated joint costs. D. The inventory cost of joint products for financial reporting. Correct. The primary purpose of allocating joint costs is to assign a value to inventories and determine cost of goods sold for external financial reporting. Correct answer. D. The allocation of joint costs is mainly required for inventory valuation and financial reporting purposes, not for managerial decision-making, since these costs are incurred before the split-off point and are not avoidable or relevant for decisions.